Welcome to Breaking News to Trading Moves.
Today we're focusing on a major milestone for JPMorgan Chase, and really what that might mean for capital flows across, the banking, tech, and fintech sectors.
Right, we're going to look at the consequences for different parts of the market based on this observed difference in how companies are valued.
Exactly. This is all about looking at the valuation multiples and then tracing the potential implications from there.
So the event that really kicks this all off is JPMorgan Chase & Co. That's ticker JPM, hitting a market capitalization above $900 billion for the very first time. This happened on January 5th, 2026. And a number like $900 billion, it puts JPM in a very, very small group of U.S. companies.
And when you see a number like that, it's not just about the size. The real question is, what is the market actually willing to pay for that size? The validation of a bank at this scale, well, it still has a certain valuation profile.
Sure.
That's the core observation.
$900 billion. I mean, it's a staggering number. But when you look at the data, the really striking part isn't just the size, it's the discount. It's this sort of valuation paradox that drives the whole conversation.
It does.
So let's start there. The headline confirms it. JPMorgan Chase, JPM, positioned to close above that $900 billion market cap on January 5th, 2026.
A first for the company. It really affirms its status.
Yeah.
But to see why this matters for capital, you have to look past the market cap number. You have to look at the metric that really dictates investor behavior.
And that would be the forward price-to-earnings ratio, the PE ratio.
That's the one. It tells us exactly how much the market is willing to pay for every dollar of earnings the company is projected to make over the next year.
Okay, and the numbers here create a real tension. Despite this incredible scale, $900 billion, JP Morgan's forward PE was only about 15.3.
And that 15.3, well, it needs context. You have to compare it to the whole market. At that time, the S&P 500 index average PE was around 22.5.
Wow, so that's a 7-point difference.
A 7-point gap. And that's where the opportunity for capital rotation really starts. I mean, it reflects a long-standing constraint on the banking sector. Historically, banks traded about 70% of the S&P 500 multiple.
And JPM is right in that range.
Roughly, yes.
Okay.
Which means even at $900 billion, the market is still applying this traditional discount to its earnings stream, even though that stream is incredibly durable.
So the average company in the index, investors will pay $22.50 for a dollar of earnings.
Right.
But for the largest, best-performing bank, they're only willing to pay $15.30. That gap, it makes you ask why. Is the market pricing in risk correctly? Or is it just undervaluing proven performance?
That's the $900 billion question. And the key is that this low PE is absolutely not because of poor performance.
Not at all.
In fact, the performance context is what makes the discount so jarring. If you look at 2025 alone, the total return from JP Morgan was about 37.3%.
37.3%. And to put that in perspective, the S&P 500 delivered a total return of what, about 17.9% that same year.
So JPM more than doubled the index.
It did. And that kind of outperformance, while you're still trading at a steep discount, it really forces you to question the market's pricing.
And it's not a one-off. The long-term view reinforces this idea of compounded strength. Over 5 years, JPM delivered a total return of about 188.9%.
Well, numbered 88.9. And compared to the market, the S&P 500's 5-year total return was approximately 96.2%.
So again, nearly double.
Doubled the market over 5 years. The track record is clear, the durability is established by the scale, and yet the valuation multiple is it's held back compared to the average.
And that's the narrative that becomes so compelling for investors. You have high, proven performance, validated by a $900 billion market cap, but the stock is still trading at this measurable discount. And that discount, it's a mechanical pressure point. It encourages capital to be reallocated.
So let's dig into that. If the PE isn't about performance, what is it about? Why is there that $7 difference in valuation between JPM and the average S&P company?
That is the crucial part. The lower PE for big banks really comes from two main things: regulatory capital requirements and the perception of systemic risk.
Okay.
After the 2008 crisis, you had regulations like Dodd-Frank and Basel III that forced these mega banks to hold way more equity capital against their assets.
So bigger cushions against potential losses.
Exactly, which means they're limited in how much they can leverage their balance sheet. Now, that makes them safer, which you'd think would boost their valuation.
But it also limits their growth and their return on equity.
Right. especially compared to an asset-light tech company with no capital constraints.
Right.
So investors have historically favored the tech story, and that results in the discount we see. The $900 billion validation just means JPM has achieved this incredible scale within that framework, but the framework itself still puts a ceiling on the valuation.
That makes perfect sense. The market isn't questioning the quality of the company, it's pricing in the cost of regulatory safety. And the fact that JPM delivered that 37.3% return despite that framework is what makes the 15.3 PE so attractive.
Absolutely. The discount provides the incentive for the capital movement we're looking at today.
So we've set up the situation, a $900 billion leader that still looks relatively cheap based on PE. This brings us right to the idea of capital rotation.
It does. The observation suggests a pretty predictable flow. I mean, when investors collectively validate a mega-cap bank at the $900 billion level, they're validating the reliability of that earnings stream.
And because that validated giant still has a PE discount compared to the S&P 500,
It encourages capital allocators to move money. They move it from areas that look expensive to areas of proven relative value.
the dynamic is simple. Money looks for the cheapest, most durable, high-quality earnings it can find.
And the direction of that flow is expected to be toward financials, which are seen as these discounted, compoundable earning streams, and away from higher multiple growth stocks.
Stocks that really rely on future promise to justify their premium prices.
You can think of it as a valuation arbitrage trade. I mean, going from a 22.5 PE down to a 15.3 PE, that's like getting an immediate 32% premium on every dollar of earnings you buy, assuming the quality is the same.
But in this case, JPM's performance validates that the quality isn't just comparable, it's arguably superior to the index average.
Which makes the opportunity very hard for institutional money to ignore.
The event also seems to reinforce what's called the scale premium in banking. The idea that the biggest banks are becoming even better long-term investment.
It does. The validation of JPM at this size implies the market recognizes that size itself is a clear structural advantage. It's widening the gap between the giants and, well, everyone else.
And this scale premium, it's not just an idea, right? It's based on tangible advantages.
Oh, absolutely. It's quantifiable. There are several critical advantages that set JPM and its peers apart, and these are the reasons investors are comfortable with that $900 billion price tag.
Yeah.
They're buying reliability.
So let's break down those specific advantages. What are they?
First, and maybe the most important, is the ability to win deposits. When there's any kind of market volatility, capital takes what's called a flight to quality.
People move their money to what they see as the safest place.
Exactly. And large institutions like JPM are seen as the safest harbor. So they attract massive amounts of funding, which immediately lowers their cost of capital. That's a huge competitive edge that smaller banks just can't match.
That lower cost of capital, it has to be foundational. It affects every single part of their profitability.
It does. Second is the capacity for technology spending. Staying competitive in finance today is incredibly expensive. You need huge ongoing investments in cloud, in machine learning, in cybersecurity, mobile platform.
Right.
JPM has an annual tech budget that's bigger than the entire market cap of many mid-sized banks. An institution that large can spread those costs over a vast revenue base. That leads to a structural advantage in efficiency and customer experience.
That makes the tech spending argument very powerful. A bigger revenue base just absorbs those massive tech bills more easily.
The third advantage is superior credit pricing. Scale brings diversification. JPM isn't just lending in one city or one industry. They have portfolios covering consumer loans, corporate lending, international finance, investment banking, all over the world.
So if one area slows down, another might be booming, which smooths out their earnings.
Precisely. That diversification lets them manage risk better and price credit more effectively. That consistency is a key part of the earnings durability that the market values so highly.
And the final point on scale.
Greater buyback capacity over time. The ability to return capital to shareholders through massive, consistent share buybacks and rising dividends is a critical factor for long-term valuation.
It creates a very robust compounding return profile.
It does. The scale premium is basically the market accepting that the biggest banks are the most reliable compounders in the financial sector, even if their PE multiple is held back by regulation.
Okay. That deeper look at the why, the regulatory side, meeting the operational scale, makes the case for rotation much clearer. So let's talk about where the money is expected to go. the winners.
Right.
So, based on this capital moving toward durable, discounted earnings, we can analyze which segments are likely to benefit. And we have to start with the U.S. mega-cap banks themselves.
The rationale is all about benchmarking. If the market accepts that a bank like JPM can deliver these kinds of returns at a $900 billion scale, it validates the entire business model for the top tier of U.S. banking.
Which means the valuation multiples for the whole group could see a re-rating.
A modest re-rating, yes.
And let's be clear what a re-rating means. It's not that these stocks are going to suddenly jump to the S&P 500's PE of 22.5.
No, not at all. But a move from, say, 15.3 towards 17 or 18. For companies this large, that would unlock a massive amount of value.
It's more of a psychological adjustment.
It is. The validation of JPM gives other investors permission to reevaluate the risk profile of its peers. The move isn't driven by fundamentals improving, those are already established. It's driven by improved investor comfort with the quality of those fundamentals.
Okay, so which are the specific names that stand to benefit from this?
You're looking at the companies with similar scale and diversification. First, of course, is the standard bearer, JPMorgan Chase, ticker JPM.
The one setting the pace.
Then you look to Bank of America Corporation, ticker BAC. It has immense scale, a powerful deposit franchise, and also Citigroup Inc., that's ticker CDA, which has vast global operations. These are the institutions that can really capture that scale premium.
Okay, so beyond those core money center banks, this strengthening of the financial sector also tends to lift other areas like capital markets and trading.
Absolutely. The thinking here is tied to market psychology. When financials are leading, when JPM is showing this kind of strength, sentiment tends to move toward more risk appetite. We call it a risk-on environment.
And that kind of environment is good for deal-making, mergers, acquisitions, IPOs.
Exactly. Stronger balance sheets and higher stock prices at the big banks signal confidence. Corporations feel more comfortable pursuing big M&A deals or issuing new stock to expand. That activity generates massive fee income for investment banking franchises.
And it also probably leads to higher trading volumes overall.
It does. Higher market confidence often means more capital being deployed by investors, which boosts the profitability of brokerage businesses. These businesses are highly leveraged to market activity.
So which companies are most tied to this increase in capital market activity?
You're looking at institutions whose revenue really depends on deal flow and trading. That includes the Goldman Sachs Group, Inc., ticker GS, which is the classic Wall Street dealmaker, and Morgan Stanley, ticker MS, which has a huge wealth management business alongside its trading desks.
And what about Schwab?
You have to include the Charles Schwab Corporation, ticker SCHW. They benefit hugely from rising client assets and increased client trading activity. Plus, they have a massive banking operation of their own.
Okay, so GS and MS are a proxy for corporate confidence, while SCHW reflects the health of the individual investor.
A good way to put it.
And this brings us to the most direct beneficiaries of all that activity. The infrastructure providers themselves, the exchanges.
Right. As you move out the chain, if trading and deal activity picks up, the actual venues where that happens, the exchanges and market operators, they benefit directly.
Right.
Mechanically.
It's all about volume. The more money that moves, say, from tech to financials, the more trades are executed.
Precisely. Increased risk appetite translates directly into higher trading volumes across stocks, bonds, commodities, and also greater derivatives activity for hedging. And these market operators, they charge a tiny fee on every single one of those transactions.
It's a beautiful business model. They have what's called operational leverage. Once the infrastructure is built, every extra trade is almost pure profit.
That's the core of their appeal. This scenario directly supports their business. They are the essential plumbing of the financial system. When capital is rotating, their revenues rise.
So which specific names are positioned to capitalize on this?
The key infrastructure players would include Intercontinental Exchange, Inc., ticker ICE. They operate the New York Stock Exchange and are heavily leveraged to data and fixed income trading.
Okay.
And you'd also look at CME Group, Inc., ticker CME. They are known mostly for their futures and options contracts across interest rates, currencies, and commodities. Their performance is a very reliable proxy for overall market velocity.
So to sum up the winners, it's a validation trade. JPM proves scale is undervalued, which helps its peers like BAC and C. That unleashes a confidence wave that helps GS and MS, and all that activity drives volumes for SCHW, ICE, and CME.
Pretty clear path.
Now we have to look at the flip side. The segments that give up capital to fuel this rotation? the losers.
The concept of capital rotation means for every segment that gains, another segment has to be the source of that capital.
Especially when the move is driven by a valuation difference. So this brings us to the segments that might face some pressure. First up, high multiple mega cap growth.
This segment feels the pressure because it's at the complete opposite end of the valuation spectrum from JPM. If capital is flowing toward lower PE, cheaper earnings streams like the banks at 15.3 PE, then the market's most crowded, high multiple names could see some relative underperformance.
And this is a really important distinction for you to understand. This pressure can happen even if there's absolutely no bad news about these technology companies.
That's right. It's a purely mechanical function of capital seeking better value. It's a portfolio decision, not a judgment on the company's performance. The market only has so much capital to deploy.
And if a lot of money managers decide that $15 for a dollar of durable bank earnings is a better risk-adjusted deal than, say, $40 or $50 for a dollar of anticipated tech growth,
that automatically creates selling pressure on the highest multiple names. They're often the crowded trades that get lightened up on when a more value-oriented opportunity shows up.
But I have to ask, the PE math makes sense, but are we ignoring that some of these companies like NVIDIA, ticker NVDA, are driving generational advances in things like AI? Is PE really the right metric here?
That is the essential conflict in the market. It's a great challenge to the theory. No one is disputing the growth story for a company like NVDA or the dominance of Microsoft, MSFT, or Apple, AEPL.
Right.
However, when the market perceives what looks like a free lunch in proven durability at a deep discount, the opportunity cost of holding expensive growth stocks goes up. For capital rotation, growth is already priced in, often years in advance. Value is measured now.
So even if NVIDIA is executing perfectly or Microsoft is dominating the cloud, if their valuations stay high, they become a natural source of funds for investors who want to participate in the financial re-rating.
That's the dynamic. The companies identified here are often the market leaders with the highest PE ratios. NVIDIA Corporation, NVDA, Microsoft Corporation, MSFT, and Apple Inc., AEPL. Their performance has been outstanding, but their high PEs make them vulnerable to this kind of focus on relative valuation.
Okay, so moving on from high multiple tech, we talked about mega cap banks as winners because of the scale premium. So conversely, the regional banks that lack that scale, they could face pressure.
Yes. The validation of JPM at $900 billion increases the perceived advantage of the money center banks across every metric: funding, technology, diversification. It creates a winner-takes-more perception among investors.
Well, why does that hurt the regionals specifically? Aren't they also trading at a discount?
They may be, but their discount is often a reflection of genuine risk, whereas JPM's discount is mostly regulatory. The validation of JPM implies the structural advantages of the largest banks are permanent and probably widening.
So it puts the regional's ability to compete over the long term into question.
It does. Their ability to compete for funding, to invest in technology, it all comes under scrutiny. Investors are very sensitive to a bank being exposed to just one local market or one type of loan.
So the durability of the regional bank earnings stream is now seen as inferior to the megacaps, even if both trade at a discount.
That's it. This pressures their valuations because their future looks less secure compared to the dominant giants. It's an issue of competition and perceived safety.
We should probably name the specific regional banks that might face this pressure.
The names mentioned are the PNC Financial Services Group, Inc., ticker PNC, U.S. Bancorp, ticker USB, and Truist Financial Corporation, ticker TFC.
Okay.
These are all solid institutions in their own right, but they just don't have the ultimate scale, diversification, or that implied regulatory safety blanket the JPM validation gives to the true megacaps.
The final area of pressure involves companies that compete with the banks but have historically traded at much higher valuations, the fintechs and payment companies.
This is driven by valuation arbitrage, just like with high multiple tech. For years, fintechs got premium multiples because they were seen as faster, less bureaucratic, and not burdened by old technology or strict regulation.
But they were the disruptors.
They were. But now, if large banks are seen as attractive core financial exposure at a discounted valuation of 15.3 PE, investors start to adjust what they're willing to pay for fintechs. The disruption story loses some of its power when the legacy player, JPM, is delivering a 37% return at a 15 PE.
So the bar gets a lot higher for the fintech sector. They can't just rely on the story of, we're better than the old banks if the $900 billion old bank is delivering double the S&P's return at a discount.
Exactly. The big banks have poured billions into their own mobile platforms. They own Zelle, which competes directly with peer-to-peer services. So fintechs need to show clearer, stronger growth and, crucially, immediate earnings to justify their higher valuations.
The market is effectively asking, if JPM is quality at 15 times earnings, why should I pay 40 times earnings or more for you?
Unless you can show truly exceptional growth. The names identified here include PayPal Holdings, Inc., ticker PYPL, and Block, Inc., ticker SQ, which operates Cash App and Square. Both are strong innovators, but they often trade at multiples that require very high, sustained growth expectations.
So if the market starts prioritizing low PE durability over high growth promise, these companies become vulnerable.
Yes, as capital moves from the potential growth basket into the proven value basket represented by the money center banks.
This has been a really detailed look at the mechanics behind a single headline. We've gone from JPM's specific PE all the way to tracing money flows across 9 different market segments.
We've broken down the central theme today. The market's validation of JPMorgan Chase at $900 billion, while it's still applying a PE discount compared to the S&P 500 average.
And this valuation disparity, it sets the stage for a mechanical flow of capital that favors scale in financials. This movement is expected to apply relative pressure on high multiple growth stocks and smaller financial players.
The key takeaway for you, the listener, is just how important relative valuation is, even among high-performing companies. When capital validates a market leader at a lower PE, it creates a gravitational pull on money across the whole market.
We'll leave you with this provocative thought. Consider how long market acceptance of this scale premium in banking might continue to outweigh the traditional growth narratives in other sectors, even in a strong market. When the market prices quality earnings at a discount, it forces a reevaluation of what true long-term value really is.
Remember, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for joining us on Breaking News to Trading Moves.
We'll see you next time.